In this section, we will go through the key components of performance fee structures. If you are very familiar with these terms, please feel free to skip to next section. This is just for someone new to the industry or whoever wants to recap. In our 9 models, we have applied catch-up clause, carried interest, hurdle rate, high watermark, and a crystallization period a lot. I personally think clawback provisions and a performance fee cap are pretty straightforward, so I did not put it into the models. But we can definitely cover them in the future if needed. We will start with the 2 and the 20 structure. The 2 and the 20 structure is a standard fee arrangement in private equity and hedge funds. The 2 is 2% management fee and 20% performance fee. And the management fee could be based on commitment or invested capital or NAV. And it could be either fixed rate or tier based. It really depends on what your LPA defines. And we will do the calculations in the next section. And the catch-up clause. A catch-up clause allows fund managers to receive a higher percentage of profit after the hurdle rate is met until their shares reaches the agreed upon carried interest percentage, typically 20%. This clause catches up the manager's compensation to what it could have been without the hurdle rate. Hurdle rate. Hurdle rate is the minimum rate of return a fund must achieve before managers can collect performance fees. It's designed to ensure managers are only rewarded for generating returns above a certain benchmark. So the catch-up is for the manager's benefit, and the hurdle rate is for the investor protection. One more component focused on investor protection we're going to go through is high watermark. High watermark ensures fund managers only receive performance fees on new profit. It prevents managers from earning fees on the same games multiple times. We will have 4 models to focus on this high watermark component. And then for waterfall structures determine how distributions are made to different parties. And there are 2 main types. There's American waterfalls and European waterfalls. And the American waterfalls also called deal by deal models. And we will have 3 models in our subsection. And then the European waterfalls is also called a whole fund model. After this quick walkthrough, I hope you have some basic understanding of the key component and how they work with each other. Don't worry if you still get confused. We'll walk through the details in our examples and models later. Generally speaking, the 2 and 20 structure forms the basic compensation framework, while high watermarks, hurdle rate, and the catch-up modifies how and when performance fees are paid. High watermark and hurdle rate protect investors by ensuring manager profit from outperformance. High watermark focus on absolute historical performance, while hurdle rate set a minimum return threshold. Catch up benefit managers by allowing them to receive the full share of profit once conditions are met, balancing out the effect of hurdle rate. Waterfall structures determine profit distribution, affecting when management fees and carried interest are paid. These mechanisms work together to align the interests of fund managers and the investors, incentivize the performance, and provide a framework for fair compensation based on fund success. In our next session, we will focus on the fund management fee calculations.